What's up, guys? Episode 47 of More Than Mortgage. Chad Anderson, Zach Jones. Hope you guys are doing well. I'm getting it down, man. Like all the fingers are going in the right direction.
Just got to be opposite. That's what
Just,
I'm. Yeah,
yeah, exactly. Just haven't I haven't done anything with the middle finger lately, but all the other fingers they're going in the right spot, so we're good. So today we're gonna kind of go back to basics because we've gone down some of these paths with theories and current events and election and rates and Fed cut and all these like deeper context type things. We thought it'd be a good idea to just basically reel it back and have a conversation on some simple things like debt to income ratio. So on debt to income ratio, this is what we're going to explain on how you qualify for a mortgage. We did the pre-qual, pre-approval. Is it legit? We did that a week ago with our recording. But Zach, so many times people just don't realize if they qualify or not, when honestly you could almost figure it out yourself. Now, I don't recommend it, but you could have an idea of whether or not you qualify because you should know what your debts are and what your income is. Pretty basic.
Yep. Debt to income is really a confusing thing because there are things that we count and things that we don't count. And maybe here's a thought, Chad, that we hadn't even talked about from a consumer standpoint. One of the things that I think we don't take into consideration in a family budget that you have to take into consideration in a family budget as a consumer is the size of your family. And there are some considerations in some loans and some little niche loans, but and just so you know, we lost you, Chad. I don't know if you can see that or not. There you go.
No, I know. I'm in the outdoor studio. The dog's barking, and she's down here peeing.
There
so if
you
you
go.
want, you ask Zach. So there we are. Okay.
There you go. So
everybody.
So if you get a raccoon on your shoulder, we'll just keep on rolling with it.
Lady's not worried about debt to income. She's worried about which bush she's going
That's right.
in.
That's right. That's good.
That's it. Yeah.
So family size, we're looking at debt to income from a very general perspective. What are the debts that show on your credit report, not your utilities, not your groceries, not all of those details, but what shows on your credit report in relation to your gross income. So we're not taking out for taxes. We're not taking out for family insurance, couple insurance, single insurance. We're not taking out any of those deductions. And so sometimes, we'll get somebody concerned about their debt to income ratio that really shouldn't be, or somebody who really needs to be a lot tighter about their debt to income ratio because they literally have 5 or 6 kids and their expenses outside of their credit report are extraordinary for childcare and groceries and clothes and all the things. So it can be a little bit confusing, but we can't discriminate against people who have more kids or fewer kids or are older or are younger, and so life cycle has a lot to do with that. We have a very simplistic perspective on debt to income ratio.
Yeah, the lending guidelines, it's some that unfortunately it's more fair to others than to some than it is to others, because like you were saying, really, if you want to get way off the tracks, which we're not going to do, is you should qualify people on residual income. That's a more telltale sign of whether or not somebody can qualify for a home. We can get into that on another episode. But on the debt to income ratio, they really do try to keep it like basic and simple. And I don't think you mentioned this, sorry, when I was messing with Lady, but the balances are not something we focus on. That's the biggest thing I hear.
Somebody you mean your credit balances.
Credit
balances.
Yeah. So if somebody has a Visa and an Amex and then like a Best Buy card and a Rooms to Go, you got 4 cards, and you say, oh, you got to have a Target card. Everybody's got a Target card. Mm-hmm. So you take those 4 or 5 and somebody will go, well, I've got, like $22,000 of credit card debt, so I don't see how I'm going to be able to buy a house. Well, that's because you're thinking of it in balances. And I barely have 3.5% down payment for $400,000. How in the world could I possibly qualify? And that's where people get confused, is that Zach and I truly don't care what your balances are when you're trying to get a mortgage. we're looking at just simply your minimum monthly payment.
Right.
I don't care that your credit card payments cumulative total up to be $250 a month payment, and then you pay $500. I don't care that it's $500 that you pay. We only care about the $250. What's required of you every single month to make a payment. And so that's what we do. And we take all those debts and we stack them up. So the balances are irrelevant. They really are. And I know there's somebody out there going, oh, what about student loans? Like, yeah, I know, different bucket. There's a calculation for those, etc.
Right.
But it is good to bring that up, because on student loans, you also most likely, sometimes you can, but most likely you can't count zero. You got to count something. So if you go, well, I don't have a student loan payment. Yeah, but the mortgage companies want to count something most of the time.
Right.
So point being, we stack up minimum monthly payments, and then we compare that to your income. I'll let you kind of wrap it up with the income piece of it, and kind of how we break it out, and also how that tells us what you can afford and what you can qualify on.
Let's just do a quick little vanilla, the easiest mortgage qualifier customer that ever fills out an application. So you got Jimmy Smith comes in and he fills out an application and he submits a pay stub, and he works for Vanderbilt, and he has a salary, an annual salary on his pay stub, $60,000. So he makes 60 divided by 12 is $5,000 a month. And then we pull his credit report, and he has a total with his car note and his student loan minimum payment and a couple of credit cards and his jet ski, $1,000 a month. So Jimmy has a 20% debt to income ratio. His minimum monthly payments on the credit report at $1,000 are 20% of his $5,000 income. And then he wants to qualify for a mortgage, and we put together a mortgage payment of $1,000 a month. Now Jimmy has $2,000 in obligations, $1,000 on all of these revolving and installment debts, and $1,000 on his mortgage. He's got $2,000 of his $5,000 income going out the door in minimum monthly payments every month, $1,000 for the mortgage. He has a 40% debt to income ratio.
Yeah, that's it.
And that's usually going to qualify for almost every loan program out there, as long as he's got a decent credit score and he does what he says he's going to do. He makes his payments on time. So 40% debt to income ratio, very handy. We don't go into insurance payments or how much he's putting in his 401k or how much he's withdrawn or how many kids he's got out or any of that stuff. Doesn't matter to us. Well, there are some loan programs that do some digging into that, VA specifically, but the majority of mortgage loans don't care about that. He is really an A-plus borrower with a 750 credit score.
And really, all those things are already factored in, because we're going to finish with this. Loan programs, on average, are going to cap you at 50% debt ratio. Now, if you are under 45% debt ratio, you are almost assured a loan, unless your credit score is just horrific. If you're under 45, you're going to be in a really good spot.
Or you have really shallow credit. You could have a 650 credit score, but you only have one credit card that's been open for 6 months. They're going to get real nervous about approving a 45 or a 46% ratio.
So if you stay under 45, you got a good shot. Really, really good shot. Best shot. 45 to 50, a lot of times you're still going to get approved, and there are other programs that you could maneuver around and still make it work. Right. When you get over 50, you kind of have one option only, two, VA and FHA. And FHA, you can go up to 57%. VA, it's technically unlimited because they go off of residual income, which is what we talked about briefly at the very beginning. So, but if you're just, again, self-diagnosing, hey, I haven't called anybody, I'm almost embarrassed to, I don't want to, I'm scared to, I don't know, I don't want to be told no, I'm shy about it. If you just do that, what are my monthly minimums on my credit report, not my utility bill? What's my gross income? I need a little room for the house payment. What does that all come out to be? If it's under 45%, you got a good shot. If it's under 57%, it's worth investigating, because you may still qualify. Right. But that's kind of the simple piece of it in a way to break it down. So anything else to wrap that up?
That's it. Let's keep it simple.
Yeah. Don't worry about balances, minimum payments. divided by your gross income, whatever your house payment's going to be, that'll tell you what you qualify for and what percentage you're in. So, all right, that's debt to income, DTI, as we call it. Appreciate you guys hanging out. These are the, I messed it up, man. I bragged on it earlier. These are the socials: YouTube, Instagram, Facebook, Mortgage Dad Chad, Zach Jones Loans. Download, like, subscribe, share, comment, hit the bell, DM, whatever you got. We enjoy it. We appreciate it. It's 47 episodes, approaching that half-century mark. So thanks for everybody hanging out with us on the channel, and we'll catch you next week. Take care.
Yep. See you next time.